stock market crash. So should you keep buying into this market, or should you sit on the sidelines and just watch it go higher? What if you could keep buying into stocks without facing the risk if there were another stock market crash? Stick around and I'll show you my strategy to take all the risk off the table while holding and even buying into more stocks. Before we get into this video, please do me a favor and help support the channel by smashing that like button. And don't forget to subscribe and hit that bell so you don't miss out on more videos like this in the future. So let me take you back for a minute to the stock market crash of March 2020. Okay? I'm sure if you were a stockholder in March, you remember exactly just how ferocious that drop actually was. So the crash actually began on March 9th of 2020. And this was a Monday. It was history's largest point plunge for the Dow Jones Industrial Average up to that date. And it was followed by two more record-setting point drops on March 12th and March 16th. So altogether, that market crash included the three worst point drops in U.S. history. And that was March 9th, 12th, and 16th. So this drop was caused by global fears about the spread of the Roni, and I'm sure we all knew that. Also caused by, and of course, the oil price drops and looming recession fears also contributed to that little crash we had back in March. Only two other dates in U.S. history had more unsettling one-day percentage falls, and they were Black Monday on October 19th, 1987, which was a 22.61% drop, and then December 12th, 1914, which was a 23.52% drop. So although this dramatic 2020 market crash is still fresh on everyone's mind, we're going to need to take a closer look at what happened and why, which will allow us to anticipate what may happen next with the economy. So, first of all, we had a fall from record highs. So the 2020 stock market crash began on Monday, March 9th, when the Dow fell 2,013 points and some change, and dropped to 23,851. That was a 7.79% fall, and it caused a lot of people to label this as Black Monday 2020. At that time, this was the Dow's worst single-day point drop in U.S. market history. Then, on March 12th, 2020, the Dow fell a record of 2,352.6 points with a close of 21,200.62. It was a 9.99% drop, almost a correction in a single day. It was the sixth worst percentage drop in history. Then we get March 16th, where the Dow hit a new record. It lost 2,997.1 points and closed at 20,182.52. And that day's point plummet and 12.93% free fall topped the original October 1929 Black Monday slide of 12.82% for one session. Wow. Prior to the 2020 crash, the Dow had just reached its record high of 29,551.42, which was February 12th peak, and went to the March low, which lost 5,700.4 points, or 19.3%. It had narrowly avoided the 20% decline that would have signaled the start of a bear market. So March 11th, the Dow closed at 23,553.22, down 20.3% from the February 12th high. That launched a bear market and ended the 11-year bull market that started in March 2009. So let's compare this to previous Black Mondays. Before March 16th, one previous Black Monday had a worse percentage drop, and that's when the Dow fell 22.61% on Black Monday, October 19th, 1987, in which it lost 508 points on that single day and closed at 1,738. On Black Monday, October 28th, 1929, the average plunged 12.82% and lost 38.33 points to close at 260.64. It was part of the 4-day loss in the stock market crash of 1929 that started the Great Depression. So what were the causes of the 2020 crash? The 2020 crash eventually occurred because investors were worried about the impact of the Rona pandemic. So the Rona mortality rate so far is more deadly than the seasonal flu's rate, but that's because many more cases of the flu are reported annually, although less deadly than SARS death rate in 2003. The Rona is spreading more quickly. On March 11th, the World Health Organization declared the disease a pandemic. The organization was concerned that government leaders weren't doing enough to stop the rapidly spreading virus. So investors had been jittery ever since President Donald Trump launched trade wars with China and other countries. But by February 27th, the Dow had skidded more than 10% from its February 12th record high. It first entered a correction when it closed at 25,766.64. So what were the effects? Often a stock market crash causes a recession. That's even more likely when it's combined with a pandemic and an inverted yield curve. What's an inverted yield curve? For those who don't know, an inverted yield curve is an abnormal situation where the return or yield on a short-term treasury bill is higher than the Treasury 10-year note. It only occurs when near-term risk is greater than in the distant future. Usually investors don't need much return to keep their money tied up just for short periods of time. They require more to keep it tied up for longer. But when the yield curve inverts, it means investors require more return in the short term than in the long term. So on March 9th, investors demanded a higher yield for the 1-month Treasury bill than the 10-year note. Specifically, the yield curve was 0.57% on the 1-month Treasury bill, 0.33% on the 3-month Treasury bill, 0.38% on the 2-year Treasury note, and 0.54% on the 10-year note. The 30-year note was 0.99%. Investors were telling the world with this market signal that they were so worried about the impact of the Rona over the next month that they needed a higher return on the 1-month bill than for the 10-year note. Note that an inverted yield curve often predicts a recession. The curve inverted before the recessions of 2008, 2001, 1991, and 1981. So in addition, both bond yields across the board were at historically low levels. Investors who sold stocks in the crash were buying bonds. Demand for bonds was so high that it drove down yields to record low levels. So how does this affect you? If you have retirement savings or other funds invested in the stock market, the crash lowered the value of your holdings. When something like this happens, many people panic and sell their stocks to avoid losing more. But the risk with that strategy is that it's difficult to know when to re-enter the market and buy again. As a result, you could lose more in the long run. If you miss important market gains in the shorter term, but on average, bear markets last around 22 months. Some have been as short as 3 months. Most financial planners recommend you sit tight and wait it out. A strong demand for U.S. Treasuries, lowered yields, interest rates for all long-term fixed interest loans followed the yield on the 10-year Treasury note. As a result, interest rates on auto, school, and home loans should also drop to record low levels. Keep in mind that even if 10-year Treasury yields fell to zero, mortgage interest rates would be a few points higher. Lenders must cover their processing costs. So in a surprise move on March 15, 2020, the Federal Reserve cut its benchmark interest rate a full percentage point to zero. It also launched a bond buying program referred to as quantitative easing, or QE, in order to mitigate the expected damage to the U.S. economy from the Roni. So, is a recession next? The bad news is that the combination of a stock market crash and an inverted yield curve can signal a looming recession. A pandemic often slows economic growth as businesses slow or close and people stay home to nurse their illness or avoid catching it. These factors could easily trigger a recession. So it makes sense to add to your savings now, if possible, to make sure you have 3 to 6 months of living expenses on hand. If you have enough cash on hand, then buying stocks isn't a bad idea because prices are low. The driving forces behind the stock market crash of 2020 are unprecedented, but strategies to survive such crashes and recessions have been proven to work throughout history. Since the crash, we've recovered very quickly. Stocks are almost back at their record highs. So people are a little bit reluctant to buy back into this market. Some people are. There's a lot of people saying that this is a dead cat bounce, and they're anticipating another crash. But this one is supposed to be much worse. Is that going to happen? We don't know. We've got the Fed that's backstopping everything to the market in order to keep everything going. So what do you do in this situation? Do you trust the Fed's money printing machine and just buy into the market and hold? Or do you sit out on the sidelines? One thing is for sure, do not use margin. If you're using your own cash and you're buying in, yes, a crash would suck, but it's not going to take you out. If you're using margin, what will happen is you're going to take a huge loss, and you'll get a margin call, and all your stocks will get sold off. So let's talk about some strategies here. What you can do to protect yourself in this situation. If you know about stock options, then what you can do, other than buying a bunch of puts that will end up expiring worthless more than likely, or lose a lot of premium if there is no stock market crash, what you can do is buy quality stocks, buy them 100 shares at a time, and then sell covered calls. That's my entire strategy of shares. So up here, as you can see, I'm at the October 16th, 2020 option chain for calls. And you can either, just depending on how much risk you're actually willing to take, but either way, it's gonna lower your cost basis, even if you were to sell a covered call, which is above your strike price. You could do this on stocks that sell or that have weekly options available. Of course, you're going to get a lot less doing that because the options are expiring in a week, so there's not as much premium there. Just depends on which stock you're trading. You can go a couple of weeks out, you can go a month out. Just kind of go take a look at the option chain for the stocks that you're interested in and see what you can get. You want to be selling these when the premiums are high. So you want volatility to be high for that stock at the time. So if it's running up, that's a good time to grab the shares and sell a call against it. You don't want to do this when option prices are down because on potential premium. So with this October option chain, as you can see, let's say that I wanted to sell a $32 call. Well, the ask is at $5.60, the bid is at $5.30. So the last price was $5.28. Now I'm recording this video in the after hours, so this option chain is not going to be accurate because I think the stock ran up a little bit after hours, but you could knock off about $530 off of what you paid and just let it sit there and let theta do what it does best and decay the value of the option, and basically reduce your cost basis, which ultimately reduces your risk. You could even go. So I was actually holding slack during the crash, and I believe it was like around $22, $23. I know it came down to about $18. So if you can anticipate about where you think the stock will go during a crash, you could you can sell that strike. So if I was thinking, it'll go back down to $18, or if I'm thinking that things will get worse and the stock will drop even lower, I can sell one of those strikes, which would be here. So for example, the $18 strike, I could be getting around $13.90 to $14.30 on just selling the covered call. So that's about a third of the total cost of the shares. Now, if there were a market crash, you're going to benefit from this because these prices are going to drop tremendously, and then depending on how long you think that this crash will last, you can either buy back the option to close it, or just let it ride and expire if you think it'll take that long. So this is a great strategy to use. I actually like to sell covered calls regardless of whether I'm thinking there's going to be a crash or not. Especially if you're holding like dividend stocks, selling covered calls, usually out of the money during, I guess, a normal market environment, allows you to collect even more money. Some people refer to it as that fifth dividend. Another thing you can do is you can sell cash covered puts instead of buying stocks right now. And then if you just happen to get assigned and have to buy the shares, you're getting them at a discount, or you're getting them at the price that you want to get them for. And until that happens, until that day comes where you are forced to buy the 100 shares by selling your puts. You're just collecting free money. So those are two things two strategies to think about while we're sitting here in anticipation of possibly another market crash, or just while we're sitting here waiting to see kind of what happens while we're trying to restart the economy. A likely scenario could be that, we'll get a wave of bankruptcies when the economy reopens, because businesses will just not make enough money to sustain them. They're not going to be making the same amount of money they were making. It could take them, years to recover. We just don't know. We have to see how everything plays out. So this is, good to have in your back pocket. Anyhow, I want to thank everyone for watching my video, especially if you stuck with it through till the end. Leave me a comment below. Let me know, if there's any stocks you want me to take a look at and do a video on, or if there's anything you want me to do a video on in terms of maybe specific strategies and how I would employ them. So I'll be checking out the comments. Hope to see some feedback from you guys. If you could, definitely, hit that like button for me. It helps support and grow the channel. Don't forget to subscribe. And if you get a free minute, check out the description below. I've got a way for you guys to get free stocks if you're not currently using a broker. I'm gonna leave a few brokers down below, or a link to a few brokers down below where you could get some free stocks for using my link. So we'll actually both get free stocks out of it. So it's a win-win situation for everybody. All right, everybody. So take a look in the description below and check out the links to the brokers I left there. They're going to give you free stocks just for signing up. Don't want to miss out on that. It's a great deal. Let's get